Looks like we're just about on time to get started for today's presentation. Thank you very much for joining us here. And we're going to look at the commodities super cycle and what's behind all these big moves in the commodity markets. If you haven't been paying attention, we're going to review a lot of material. We have a lot of visual aids, so this should be a lot of fun. You know, looking at these bullet points here, there's been a lack of investment into the capital intensive commodity space for many, many years. And a lot of the experts are suggesting a rotation into this, what they call asset heavy allocation. What are the markets doing in response to Iran? Some of these commodity experts are talking about really the market being out to lunch, mispricing things. Commodity merchants saying that physical deliveries have stopped. Everyone's afraid of shortages and not getting any more of what they need. So you have these shortages spreading around the world. So we're going to get into this here, and you're welcome to ask questions along the way. We'll have time at the end for Q&A as well. And as we get towards the end of this, we're going to have kind of a little bonus sneak peek, as we call it. There's an incredible opportunity coming this summer, and we're going to show you what that is with some new developments in the markets. And before we get into the meat and potatoes of this, take a look at the risk disclosure here. You can take a screenshot and read the whole thing at your leisure if you'd like to, but keep in mind you should be using risk capital when trading commodities, and past performance is never a guarantee of future results. And of course, there's always risk of loss when speculating. A little bit about Altavest, and we've been doing this since 1997. We are a registered introducing brokerage firm in the futures and options space, doing this for almost 30 years. We developed proprietary options technology years ago, and we've traded tens of millions of futures and options contracts along the way. And that is yours truly here with my business partner, Mike. We'll introduce ourselves in just a second. That's on the trading floor, the S&P 500 options trading pit in Chicago. Some of our floor staff that would fill our orders and operations as well there. A little bit more about us. We're registered with the CFTC. We're members of the NFA. We're located in California. And I mentioned myself and my partner, Mike Armbruster. We're the company founders, and I started in 1991 with my Series 3 license for commodity futures and options. I have my BS in business administration from University of Southern California, and I'll let Mike introduce himself. He's here, and he's on video. My video, for some reason, wasn't working, but go ahead, Mike.
Oh yeah, you're stuck looking at me today, but yep. You went to University of Kansas, undergraduate in accounting, and started the business a few years after Eric in 1993.
Yep, very good. Okay. And maybe you've seen some of our work and materials and presentations in the past and some of these other venues along the way, lots of webinars and presentations. We have more good stuff coming up the next few weeks as well. Even live events. This was in Miami, or I spoke in that event there. And we often get quoted in the financial press. Perhaps you've seen us mentioned in MarketWatch. Here is just a couple weeks ago asking about what's going on with gold and Iran and crude oil and so forth here. And I guess they caught you here, right, Mike? They quoted you here talking about energy prices?
Yes, they were asking about energy and you know, what the relationship was with gold, and you know, where things might be headed, you know, for the rest of the year.
Right, right. You mentioned the global macro setup for gold in the second half of the year. In fact, we might even talk more about that in just a few minutes. And you can see more quotes there from Altavest talking about oil slowing the GDP growth in the second quarter. So yeah, that's sort of what we're going to talk about in part, and as well as many other things as well. But some of the key factors for the commodity markets: inflation, of course, central bank demand, monetary policy, export controls, industrial demand, and then just that lack of investment resulting in production deficits. And then jumping into the inflation aspect of it, from Milton Friedman, we always like to hear from his wisdom, but he mentions that consumers don't produce inflation, or producers don't produce inflation. It's produced only by too much government spending and too much government creation of money. So essentially, it's a fiscal and monetary phenomenon, I guess you could say. And when you talk about inflation, we often refer to purchasing power. That's how we relate to inflation, but it also means an inflation of money supply. But here's what a dollar was worth in 1978, and now it's worth about 19 cents. I'm sure we can all relate to that. And here are a couple of recent data points to look at. So the producer price inflation surged to 6% year over year, well above expectations of 4.9%. So the highest level since January of 2023. So basically, you're looking here at producer price inflation along with this consumer price inflation index. We'll look at that in a second here in a graph, but we're now at 3-year highs. So the odds of a rate hike are actually rising. So you can see this big spike. So that's really no surprise, I suspect, considering what's happening with energy prices, and certainly beat forecast. And here's a little analog of inflation from the 1970s versus today. And whether or not this plays out exactly like it did in the past remains to be seen, but certainly the way things are playing out at the moment, you've got a situation that's kind of set up for really, we've maybe just seen the beginning of the price spike in inflation. So what do you think about that, Mike?
Yeah, well, I mean, some of the research that we subscribe to and some of the forecasts have inflation running up to closer to 5% by the end of this year. So, definitely, I don't know if it's going to be a perfect analog with back in the 70s, but we, likely do have more inflation going into the end of the year. So that's, those estimates have been, I think, directionally correct from our research firm that we subscribe to, Hedgeye. And, we'll see about 2027. But yeah, certainly I think we're going to follow that analog a little bit longer into the end of the year.
Right, and the markets are certainly pricing in no rate cuts for this year either, that's for sure. In fact, you're perhaps looking at rate hikes.
Yeah, I think by the time we get out to March of 2027, there's a greater than 50% chance that there'll actually be a rate hike. And there's almost zero rate cuts priced in between now and then.
Right. Okay, well, let's look at gold real quickly here. This was interesting here. Gold was finally overtaking US Treasuries as the world's largest foreign asset reserve in 2026. So here's what that looks like on a graph. So you have world central bank holdings of gold are now greater than Treasuries. You can see the central banks are basically selling Treasuries and at the same time buying gold. So you can see here the interest there crossing over. So gold is becoming highly favored versus Treasuries at the moment. And gold is making history now. 24% of global central bank reserves are now held in gold, surpassing Treasuries at 21%. First time since this has happened since the mid-1990s. Any other thoughts? Well, in fact, here we can look at the graph here of maybe why that's happening. So what do you think? Do you have any other thoughts on that, Mike, as to why that's happening? Why are central banks jumping into gold?
Yeah, well, they just see all the fiat currencies around the world being debased, money printing. That's how we're financing our deficits, is just, printing money, literally. They're kind of not talking about it. They're not calling it QE. I think they have some other name for it these days.
Is there a repurchase of something? Yeah,
something. Yeah, I forget what they're calling it, but it's just the same thing. So, central banks see that and they'd rather hold gold than a dollar, a fiat-based asset. So.
Right. In fact, here's another economist we like to pay attention to. He commented just on kind of what Mike was talking about: the monetary excess, the insane fiscal policy, and means the demand from central banks remains, and supply and demand fundamentals are robust as ever. Talking about gold, so it's political and also economic or an industrial. There's lots of industrial uses for gold as well too. And if you didn't know it, gold is the largest asset in the world. I just took this screenshot yesterday. So gold has an market cap here of $32.6 trillion, and the next largest market behind that is NVIDIA at 5.9 trillion. So very interesting, just to put things in perspective. Gold sort of dwarfs, the other markets are dwarfed in comparison to gold in terms of the market capitalization. And the best performing asset in the last 20 years, well, you probably get the hint that it's almost gold in terms of the last 20 years here. Not almost gold, it is gold, beating the S&P and the Russell, the small cap. So you can see in the last 20 years, gold, certainly has its ups and downs as well, but what market doesn't? What was interesting here, you see in 2008 to 2013 or so, the stock market in general was obviously struggling, and then gold took off, and then as the stock market starts to recover, gold pulls back, and then it kind of goes sideways. And so you can see sort of that non-correlation or inverse correlation at times to what's happening in the stock market. But in terms of where we are now in the bull market related to gold, well, it could be that we have a long way to go when you look at history. So back to 1970 to 74, this period, and the period here 76 to 80, and the other two periods here, you can see these bull market gains. And now here's the bull market that we think we're in. We clearly are in a bull market in gold, and there's certainly lots of room, lots of space there for that market and that rally to continue. So could have a long way to go. And here's a money manager here, Luke Groman. He's suggesting gold could hit up to $25,000. He mentions here over the next 5 to 10 years, gold has outperformed the S&P total return in the last 1, 2, 5, 10, and 20 years. He says his entire career, he's made more money just sitting in gold than owning the S&P. So as we saw in that chart, that is true. And so we're going to look at some gold futures contracts and how to get involved with gold. Remember, futures contracts.
By the way, Eric, we have clients that have done that very thing, outperformed over the last 20 years, literally, in gold.
Yeah, absolutely, they have. That's just about the one and only thing they've traded, and just been rolling their contracts when they come due. And certainly it's been paying off lately, that's for sure.
Yep.
Okay. So you've got futures contracts. If you're not familiar with them, we can certainly help you with that. But essentially, everything is the only thing that changes with a futures contract is the price. So the quality, the quantity, the delivery, the location, everything is contractually the same. The only thing that we're trading is just the price. And why do you want to look at futures versus ETFs? Well, how about margin efficiency, trading more with less, control a larger position with only 5 to 10% of the required margin compared to stocks and ETFs. And we'll look at some examples. They have liquidity, they're tradable around the clock. You get the tax efficiency, the 60-40 tax treatment, and we'll talk about that. But essentially, 60% of the profits are taxed at your capital gains rate, which is typically lower than your personal income tax rate. And then there are fewer trading restrictions. I know they have some pattern day trading rules that have been changed lately if you're trading stocks, and I'm not sure exactly where they ended up with that, but I think it's actually a little bit less restrictive now. But nonetheless, there's a lot of advantages when trading futures versus stocks or ETFs. And here's an example if you're looking at gold at $5,000 an ounce, and let's look at the 1 ounce futures contract. At that level, the margin is $390. So you have $390 of capital required to maintain a position in something worth $5,000. So you have that efficiency ratio of 13 to 1. But if you want to trade an ETF of gold and you want $5,000 worth of gold in that ETF, well, you pay $5,000 to buy that ETF. So you don't have any margin efficiency with securities and ETFs versus what you would have in futures. And looking at gold, there are various sizes. You have a 1 ounce contract, 10 ounce, 50 ounce, and 100 ounce. If you've got 100 ounce contract you want to trade, the margin requirement here, just in this example with gold trading where it was around $46,000. So you have to keep in mind the size of account you have, how much risk capital you have, and then you can kind of work backwards into which size contract may work for you. And so just a little review here, you've got the 1 ounce contract, you've got the micro gold, which is 10 ounces, the E-mini gold, 50 ounces, and the COMEX gold is the 100 ounce contract. So those are all tradable. We have clients doing, I guess, pretty much any and all of the above, just depending on your situation. So you want to run through this example real quick, Mike?
Sure. Just looking at, if you had $15,000 that you wanted to allocate and be involved in the gold market, like Eric said, 15,000 in an ETF gives you $15,000 worth of exposure. Whereas if you just did one micro gold contract, which is 10 ounces of gold, the margin on that is $3,276. Obviously, you don't want to fully margin your account. You want to keep that at, around 20% or less is kind of a rule of thumb. And that would control $46,000 worth of gold. So that's how we approach the leverage there. So you can see the examples, up 10% in gold, you get a 10% return in your GLD. Likewise, with the futures, you get, $4,600. So quite a bit of leverage there.
Right. So the key is margin efficiency versus trading securities or ETFs. And of course, the leverage involved works for or against you, but you still do have efficient use of capital, that's for sure. And now looking at
you can, and just to go back to the leverage, I mean, you can, depending on your risk appetite, you can dial in, you can even be 1-to-1 risk in futures if you want, or you can be at 1.3, 130% or whatever, as opposed to just 100% in the ETF. You can just add a little bit of leverage, or you can go a little bit further.
Right, absolutely. You can kind of be very granular, especially with all these different contract sizes here. You can have a 1 ounce contract of gold, and then the margin amounts here too, of course, are based on the price, and the exchanges set those margin requirements, and it's a deposit, it's not a cost, so keep that in mind. But so depending if prices get dramatically more volatile or they appreciate dramatically higher, you can see that margin requirement move up as well. So keep that in mind. And here's silver. It's the 3rd largest asset in the world. Here's a graph of silver compared to gold, the S&P, and the Russell 2000. So you can see silver actually has been just barely outperformed gold in the last 20 years. Well, I took this snapshot yesterday, I believe. So again, silver, gold, you kind of have that non-correlation or inverse correlation at times with what's going on in your traditional asset classes. So these are definitely in the alternative space. So you have industrial demand for silver surging. You have breakthrough technology for batteries. Do you want to make a comment on this battery? I know you've been kind of reading about this more.
Yeah, I mean, last fall, Samsung announced they had a breakthrough in silver-based batteries, and they're talking about ranges of 700 to 900 miles on a charge. This says with just 9 minutes charge. That would be pretty crazy, and that might even encourage Eric to even buy an electric car. He's a car buff.
they're too reliable for me. I like old things that break down.
There you go. So but yeah, the demand is expected to be off the charts for silver. That's why China's been hoarding silver, and they have their own BYD is a electric car maker in China. I think the largest car maker in the world, and they also have their own silver-based battery. So demand for silver has, before these batteries came out, we were already in a production deficit, meaning that demand, usage of silver has been more than what's been mined every year, the production. And that's been going on for about 5 years. And you can say a similar story in the copper market and some of these other markets. But so that's the basis. That's the reason why, one of the reasons why silver has been moving so much. And the solar panels is another use for silver, and maybe there might be some substitution for some copper technology they're talking about to replace some of the silver. But the silver-based batteries, could be much bigger than anything else. So those are the fundamentals.
Well, speaking of which, we'll stay on track here with silver. This was just earlier.
Yeah, a few weeks ago.
Yeah, Bank of America talking about silver. They're looking at based on the gold and silver ratio. So you want to explain that here? They're suggesting silver could be $135 up to $309 an ounce this year.
Right.
So they're talking about this ratio, right? So if you want to.
Yeah. So the ratio right now is about 55, and it wasn't so long ago. Just last fall, we were up around 100, which is usually a great buying opportunity for silver, and it turned out that was the case. We certainly had a few clients buying silver then, and that was one of the signals we had was the gold silver ratio. But this Bank of America analyst is probably looking back to the 1968 timeframe, when it looks like the gold silver ratio got down to about 14, and is using that as the top end of his estimate. So I mean, picking upside targets is it can be kind of silly business, but the message is clear that the demand fundamentals argue for much higher prices. You just can't start a silver mine overnight. It takes a long time. There's been underinvestment in the mining industry in general, and most of the silver production doesn't come from, there's no real like silver only mines. Most of the silver that comes out is a byproduct of a gold mine or maybe a copper mine.
Iron or copper, right.
Right. So
I love this chart at the bottom back to 1693. We didn't go all the way back though, but so really this chart here says that if you're looking for that ratio to move back up again, you've got to either have gold drop a lot or silver go up a lot. I guess is really what we're saying here.
Well, it's the gold silver ratio. So I guess for it to go back up to 100, gold could just take off without silver, I suppose.
Right.
But what they're saying here is that silver is, if it goes to 14, silver is going to be outperforming gold, and so that ratio will fall. So you're dividing the price of gold by silver to get a smaller number. And so I mean, anything's possible. The silver-based batteries is a big deal, and there's no reason why we couldn't go back down to that historical low around 14.
Right. Yeah, and just for context, here's a silver chart at the moment.
Yeah, we're $85 right now. He's talking about a minimum of 135 by the end of the year, so that's like a 50% increase.
Yeah, so new highs, break these highs here. Okay, and then looking at futures for silver. So here are, again, there are different size contracts, but in this example here, you've got a margin requirement of $1,400 on a 100-ounce silver contract. Silver here, with $8,000 in notional value, or the contract value, or essentially another way of saying that you've got $8,000 worth of silver that you can trade with a $1,400 requirement as your per contract requirement. So your efficiency ratio here is 6 to 1, and versus of course your ETF or just buying an outright security, it's 1 to 1. So you don't really have any efficiency when you're trading ETFs and securities, but you do in the futures market. And again, just to review, different size contracts for really any amount of risk capital you have in mind. You've got the 100-ounce contract, margin of about $800. Here's the micro contract, that's 1,000 ounces. And then you've got the larger contracts, 2,500 ounces, and then the 5,000 ounces. I remember years ago, there was only the 5,000 ounce, but of course silver was, $4. So in any case, so that just gives you an idea of all the flexibility available. We looked at gold, we looked at silver, we're gonna look at a couple other things, including copper at the moment. Really doesn't get much press at all. Every now and then of late it has, so we're gonna show you some of these comments from some of the people following copper, betting on copper and cables over AI. So you're kind of looking at investment money being, I guess you could say, allocated towards hard assets rather than AI and technology. Here's what copper's been doing lately. If you've not been following copper, I shouldn't say lately, this chart goes back to looks like the 70s here. And you can see we're at record highs here. Steven Hanke, an economist here. Isn't he with Johns Hopkins, I believe?
Yes, that's correct.
Yeah. So he says, he's been talking about this for a while, actually. You want to be long commodities, commodity markets entering the super cycle, copper on track for its highest closing price in history. And just a few other comments from these other veteran traders and I guess you'd say asset managers. He says the energy market transition and the massive power needs of rising populations is a concern of his. We're looking for a decade of high double-digit returns because of the underlying market of electrification. We'll need a huge amount of natural resources. So he's looking at copper and any other few bits here. Let's see what else I could pull out here. Yeah, he's basically looking at, he gives an example of India. The average Indian citizen yearly energy consumption equal to 1.7 to 2 barrels of oil a year versus 24 barrels per person in America. But India's population could double by 2040. So that's crazy. 14 years, Indian population could double. That sounds astounding. So up to 2040, that means from a consumption of 20,000 terawatt hours of electricity, you'll need an extra 18,000. So to play this, invest in copper and aluminum. To transport the extra electricity, you'll need 100 million kilometers, I guess you could say, or kilometers if you're European, I don't know, of new cables. That's equivalent in terms of copper to 2 times the yearly consumption. And here's what copper looks like if you want to look at it in relation to the S&P 500. So it's outperformed the S&P 500 by a factor of 5 to 1. So we're back to these 1999 levels now when you're looking at that ratio. And here's a graph here of, you've got the S&P is black, that's the bottom line, and then you have gold, which is the gold line, then you have the copper colored line right here, and then blue is the Russell 2000, and then silver has been outperforming the last 6 months. So just looking at all the metals essentially here in comparison to what the S&P is doing, thought might give some context and perspective. Basically, here's some other investors talking about the new bull case for copper, basically looking at mines and not technology. Stanley Druckenmiller says it's the tightest position he's ever studied. They talk about electrification makes shortages inevitable. It should go parabolic. Investors still don't grasp the scale of the problem. You can't own enough copper, and we have to mine the same amount of copper in the next 18 years as we mined in the last 10,000 years combined, just to maintain, I guess, our 3% GDP growth. And then more from Stanley Druckenmiller, no meaningful supply online in the next 8 years. AI and data centers add to that demand. Not going long copper equities, but he's using futures contracts. So he's long copper, he's long gold, and it's his greatest conviction call. If you don't know Stanley Druckenmiller, he's kind of I guess one of the world's best money managers. He did, was it 30, what was it? Was it more than 30% annualized every year for 20 plus years?
many years, yeah.
Yeah, with no drawdowns on any year either. And anything else you want to add on copper, Mike?
You know, I mean, you get the AI data centers that everybody wants to build, and then beyond that, you have to build out the energy infrastructure in the U.S., which there's just probably a lot of these things just won't happen because there just isn't enough raw material. So that could be a real limiter on how far this AI boom can go, just because the raw materials just aren't there. So I don't really have
Right.
much more to say than what Druckenmiller says.
Right. Okay. So looking at copper futures contracts, we'll look at some of the different sizes available there. You've got micro copper, 2,500 pound size, so $1,200 for the margin. You've got the E-mini contract, so 12,500 pounds. And then you have the full size contract at 25,000 pounds. So don't worry about the pounds and all that. It doesn't really matter. The main thing is, what's the margin on the contract, and what does every tick mean in terms of dollars and cents to you? And that's something we can certainly work with you on and make sure you're clear on all that and how that works. But you have lots of different options available. You have micro copper futures, and you have 1 ounce gold, you've got micro gold, you have 100-ounce silver, larger contracts, bigger contracts, smaller. Really, it's a matter of what's comfortable for you and the amount of risk capital and what your goals are. And then there's also crude oil. How can we forget crude oil? So here's a chart of the July crude oil contract. Obviously the rally here, and then you've got further acceleration here with what was happening in Iran, and then you pulled back quite a bit, and now we're kind of hovering, getting close to approaching those highs. You've got Asia and Europe highly dependent on what's happening over there in Iran out of the Strait of Hormuz. Interesting that we're only 2% dependent on the actual oil coming out of the straits, but Europe, India, Japan, I think China, 50%. I mean, obviously, interesting, President Trump's over in China, and I'm sure we've all read the news, but China certainly has an interest in keeping the Strait of Hormuz flowing, that's for sure. But here's what's happening. We're burning through oil inventories at the fastest pace on record. So let's see here if we can look at this chart. Stockpiles have fallen by 4.8 million barrels per day, exceeding the peak COVID drawdown. So once inventories run dry, we will switch again from an oil deficit to an oil shortage, then prices will spike again, according to Steve Hanke. So here's that chart there. I don't know if you had any other insight or comments on that.
It's I think we've talked in the past how we're just amazed with what's going on, that we haven't seen something north of 150 or even $200 yet. Prior markets, I think, would have reacted much faster, but for whatever reason, the markets think this will go away, and oil could start flowing next week, but there's no indication that will happen. And even if it did, it's we don't know what kind of damage has already been done to infrastructure. So it's not like just turning on a faucet again and everything starts flowing, and then once it does, it takes a month or two to get to destinations and so on and so forth. So, and there's the risk that things could drag on for another month or two, or who knows. Right. So we're at the moment where the United States is exporting oil out of its strategic petroleum reserve, and basically trying to make up the difference to different places around the world, like Europe and maybe parts of Asia, so they literally don't run out. But we can only do that for so long. So the futures prices that we're trading, those are US futures prices. And at some point, it's a question of, if we start seeing supply disruptions or literally running out of supplies in different places in the world, places like the Philippines or maybe even Europe, then and we've run down our SPR reserves, we're going to start seeing. It's probably going to be something. If I had to guess, it's kind of that saying where risk builds slowly, then all happens all at once. I could easily see, a spike to whatever level needs to happen to destroy demand. Is that 140, 150? Is it 200? Nobody knows, but it's probably not current prices.
Right. Yeah. Morgan Stanley suggesting demand destruction is negligible until at least 140. So we shall see.
Right.
But yeah, I think the only reason we're where we are is because we are releasing the SPR every day. I think a deficit of isn't it like 4 million barrels a day?
It was 8 million last week out of the SPR, plus another 4 million in commercial reserves. So, those are I've never seen those types of numbers. So.
Right. And Europe is running out of jet fuel. Wasn't it Lufthansa a couple of weeks ago canceled 20,000 flights?
Yeah.
They're running low on jet fuel, and there's a bit of a, looking at England as well. They're having to sort of ration their fuel. So,
my brother,
we're a little bit.
Go ahead. My brother took a trip to Italy, and so I sent him. Once he was already over there, I sent him the trip about Europe running out of jet fuels.
You may stay there a while.
Yeah.
Yeah. Anyway, okay. But there are different size contracts again for just like the metals, but the crude oil market as well. You got the micro crude margin of just about $1,100, the E-mini crude margin of $5,500 approximately, and then your full size contract margin of just over 11,000. So you have the 1,000 barrel contract, 500 barrel, or the 100 barrel. So again, a lot of flexibility there. And depending on the exact price of the crude oil any given day. This is just an example we had when it was at 108.5. But a lot of opportunity here to have positions in these markets to really suit your account size and the risk capital that you've got. And we're going to look at some agriculture now, something that doesn't often get talked about. But the wheat market here, the U.S. is set to have the smallest wheat crop in 54 years. And that's something that kind of surprised me, actually. Weather has been challenging the winter wheat crop and low yield with low planted areas. USDA projecting smallest U.S. winter wheat since 1965. And then here you have Steven Hanke again talking about the commodities supercycle in play. This is just from today, yesterday.
I think that was maybe yesterday.
Yeah. And here's quotes on wheat, corn, soybeans. Basically, everything's green and been going up for some time. Here's a graph of wheat. Just earlier this year, we were down around 530. We're approaching $7, and we pulled back. So anyway, a lot of opportunity in the ag markets, and we won't go into every detail of all these contracts, but again, you have different size contracts available in these markets as well. Here's corn. Anything there on corn other than what you can read here, Mike? Anything else to say about that?
Well, yeah. I mean, just overnight, there's Trump is in China, and he's, getting the Chinese to say at least that they're going to buy more corn and soybeans from the United States.
Mm-hmm.
Overnight, the House of Representatives, that's what this is about, authorized year-round production of E15 fuel, basically ethanol, corn-based additive for gasoline. So that's more demand for corn as well, for obvious reasons, wanting to create energy from any source possible. So yeah, and there's corn. It's down today, but this is a snapshot taken just a few minutes ago.
Right.
Obviously, the trend is up.
Very good. And then even looking at livestock, the cattle herd in the U.S. is smallest in 70 years, kind of similar to the wheat story. And again, this stuff tends to fly under the radar. You don't hear this talked about hardly ever on, business channels and media and stuff. It's not as sexy, I guess, as AI and all this stuff. But here's the live cattle market. Boy,
Looks
we
like an
used to
uptrend to
trade
me.
this. Yeah, I remember we used to be trading this when it was
80 cents.
50 cents. Yeah, 50
Yeah.
cents, 60
Now it's
cents.
$2.48.
Yeah, yeah. And more ag products here, sugar. Let's see. Again, they're talking about ethanol, but what else do you
Yep.
have to add here, Mike? Anything?
Sugar is another commodity that can be turned into energy and ethanol. So, Brazil's doing it, India's doing it. So
Okay.
that's those bullish factors.
And here's a graph of sugar, kind of a bit choppy. Certainly, this would be 15 cents a pound, right?
Right.
Yeah. Okay. Now here, we've talked about all these different markets, whether it's metals or energy or even these agricultural markets, but here's one market that kind of puts the whole thing together for us in just one index. So this is the Bloomberg Commodity Index. The symbol is BCOM. So you have 24 markets represented in just this one index, and I think this was from yesterday. I took the snapshot.
I was actually early. I replaced your chart. I got a one from this morning. So
Okay, you got this little pullback.
yeah.
Okay, so to explain this, the Bloomberg Index, known as BCOM, a leading commodities benchmark providing broad-based exposure to commodities using 24 of the most traded commodity futures contracts across 6 different sectors. So this is the breakdown, all the details, but generally speaking, energy represents 29%, grains 21%, industrial metals 16, precious metals 19, the soft, so that would be like coffee, sugar, cocoa, cotton, and 9%, and then livestock like cattle at 6%. So you have exposure in that one index to all these different markets. And you can see there's a heavy concentration essentially in energy, and then between the industrial metals and the precious metals, you've got about 35% exposure there. So that's a really interesting way to view this and to look at this. And what's interesting too is it's very tradable. The margin is only $800. Trades in 4 different contract months. So certainly something to consider if you want exposure to the class of commodities and all the different sectors outlined here.
Yeah, if you want to go back to that chart of a few slides earlier of the index itself, you can see, yeah, it's a fairly smooth, rally, whereas, some of the, whether you're looking at sugar or some of these other markets, can be a little bit more jagged. When you have an index of commodities that really smooths out the ups and downs, they're not always moving in sync at the same time. Crude might be in a big run, and when gold is not, and vice versa. So that's a great way if you're like, oh man, I don't want to pick the wrong one at the wrong time, and this, that, the other. This is a great way to do it.
Right. And just from the data on the graph here, that would be back to September. This index has rallied, looks like 40%. Is that about right?
Yep.
Yeah. So that kind of smooths out the peaks and the troughs anytime you have an index, just like the S&P 500 versus an individual stock will have less volatility. And again, the margin is very approachable. $800 at the moment. I mean, that margin can change a bit over time as the price of the index does, but it shouldn't deviate too dramatically different from that number at any, in the near future. So here's some more examples. If you had a $25,000 account, you might look at buying a micro copper and a micro gold, or if you just wanted to have exposure to the commodities index, the BCOM futures index, having exposure to all those different commodities, You could buy maybe 6 contracts at the margin of only $4,800, and then you have $86,000 worth of commodities in that index. So what do you think of that, Mike? Does that make sense for, or any other thoughts on that? How to, slice that up and dice it up?
No, I think, I think the thing is really, in this environment, I personally like the commodity index at the moment. And there may be times when you want to emphasize, one market like gold or energy at various times. But, if you don't want to have to worry about that and you want to be in it for the longer cycle, then something like the Bloomberg Commodity Index makes a lot of sense.
Yeah, absolutely. And then even if you had a slightly smaller account, there's certainly things you can do with that as well. Again, these are just examples. You could use the math any way you'd like to allocate your resources to whatever markets you may have an interest in terms of prioritizing, or maybe some recommendations that we might have as well. But micro gold, in this one example, you could do that. That's fine. You could do micro copper, 100-ounce silver with a 1-ounce gold. In this example, you could just do 3 contracts in the Bloomberg Commodity Index as well. So, you can kind of, or maybe you want to focus on the Bloomberg Commodity Index and then have a contract or two in, any of the other markets that maybe kind of have less emphasis on the ag markets, and you want to maybe boost your exposure into the energies or metals, and you could do that just as a one-off. So
yeah, or if we got a rally in crude oil to $200 a barrel, then maybe you want to de-emphasize energy because you've had the run that's likely to create a lot of demand destruction, and over time probably won't appreciate dramatically from that point. I mean, you never know what's going to happen, but maybe you want to de-emphasize your energy and rotate out to something like gold or something else. So that's something that we can help you with the timing.
Right. Yeah, the point, I guess, is it can be customized to emphasize or de-emphasize really any allocation that you would like. And why are we even looking at this? We kind of hinted at it, I guess, and mentioned it earlier, but these have a lot of these markets, and commodities in general tend to be less correlated to the general outcome of the stock market per se, or traditional asset classes. So with one thing zigging, another thing could be zagging. So you don't have to have a big bull market in the stock market for commodities to move a particular way. So we think it makes a lot of sense to have that diversification in your portfolio. And this was interesting here, the traditional 60-40 bond or stock and bond portfolio, looking back in history, it often fails, especially when inflation surges and bond yields are up. In fact, bond yields, a 30-year treasury is above 5% for the first time since, is it the mid 90s?
I believe so. And and so when those yields go higher to compensate, buyers, new buyers, to attract them to buy those bonds, that means current buyers, they're seeing their bond prices go down. So they're seeing their investment drop. So that's why the 60-40, when inflation goes higher and yields shoot higher, the bond portion of the portfolio suffers.
Yeah, the bonds don't help you at all, they hurt you.
Right.
So you can see these areas here that are highlighted red, just the periods of time in the last 5 years or so where that 60-40 portfolio actually failed you.
And they were talking about that this morning. Hedgeye was actually talking about that, and you think, oh, 60-40, that's passe, but apparently it's still quite
stuck on Wall Street.
Yeah, Wall Street and just old time investment managers, they just have always done that, and they're still doing it apparently to this day.
Yeah, for sure. And they're talking here, gold at the heart of the modern portfolio. Ray Dalio, investors should have 5 to 15% in gold. Morgan Stanley should be more like 20%. Bank of America suggesting 30% is rational, but the average portfolio manager is at 1.9%. So, so no one has a meaningful gold allocation. We're witnessing a paradigm shift in portfolio construction away from the 60-40 toward an equity/gold portfolio. The bull market in gold is far from over. So yeah, JP Morgan, Bank of America, Goldman Sachs, all recommending large allocations to gold and commodities, not just token 1 or 2%. I remember years ago, that's what it always was. Anytime you talk to someone on Wall Street, on finance, oh, sure, you can have 1 or 2% if it makes you feel good, you know. Anyway, and here's a couple of interviews that we saw actually from these commodity experts. So here's Jeff Curry, and let me see here.
He's the former head of commodities at Goldman Sachs, and they started their new firm, ABAX Technologies.
Right. So he and his partner, we'll show his partner here in a second, but he kind of talked about this here, where the new economy is asset light software, so infinitely scalable at no marginal cost. And so what happened is this duration plays, that's the one that got all the money and all the investments, and meanwhile this starved out the capital needed to grow in the commodities space. So everything's been pouring into software because there's really very little investment needed for that other than technology programming, right?
And a few chips and data centers. You know?
Yeah, and then meanwhile, the actual physical commodities that the world needs to operate and run on, that market's been neglected. And
yep, no new mines.
No new mining, and you talk about rare earth metals, you name it. But so,
in fact, last year, I think one of the world's largest copper mines in Indonesia collapsed. And
that's true.
You know, yeah.
So they're talking about rotating from this asset light investing into asset heavy. It's been ignored since 2014, since the oil price collapse. So they call it HALO, or hard asset, low obsolescence. So that's what they're favoring now. Anything basically physical, tangible, a hard asset that will never go obsolete. It's not trendy. It's been around since the beginning of time. So the materials, the raw materials, the raw commodities is what they're talking about. It says markets are out to lunch on how severe the situation in Iran is. We lost 1 billion barrels of oil, the biggest supply shock ever seen, with spot oil at 120, yet the forward is at $70. So that's kind of like Mike mentioned earlier, the crude market, and some of these other people too are suggesting the crude market's asleep. And part of that is because we're kind of making up the supply with our emergency supplies. But there's only so much of that to go around. But they mentioned bonds and inflation expectations, looking at the back end oil prices, thinking it's temporary, but it's not. We've shut in 10% of the world's production. We don't know when it's coming back. Shortages are spreading. And then here's his partner, Josh Crum, used to work with Goldman Sachs, senior commodity strategist.
Yeah, so just to kind of reiterate what Jeff Curry was just saying, basically, today you've got the NASDAQ making new all-time highs right now, but they're suggesting, hey, it's time to be getting out of, these huge winners in technology and moving into commodities.
Yeah, that's what they mean by rotate there. Rotate from the asset light, which means, software, all this software related, software as a service, that kind of thing, into the HALO, the hard asset, low obsolescence space. And his partner here says something similar, just with fewer words. We're with all the major physical commodity merchants, and they're pounding the table. People don't understand that physical has stopped. So what's he talking about there, Mike?
Physical supplies are getting hard to come by. It's it's as simple as that. I mean, I think
whatever supplies.
Production deficits and copper, platinum. I mean, 70 or 80% of the world's platinum comes out of South Africa, which is not the most stable place in the world. But it's still, even when it's producing full speed, we're still at a deficit. It's the same thing. Obviously we've talked about copper, and gold is just being accumulated by central banks like crazy. So. And now we have the crude oil, the energy markets, We've got the Middle East shut off. You've got fertilizer, which is a big byproduct there, not flowing out. That's going to impact ag and crop production around the world. So it's a huge ripple effect.
Right. It's not in none of this happens in a vacuum. And I imagine if you're a vendor and you are in need of raw materials to operate your business, whatever you have on hand, you're not selling. I mean, or
Right.
if you do, it's going to be at a dramatically higher price because you need it. So, Bank of America here, again, talking about commodities can dominate the rest of the decade. BlackRock moving away from the 60-40 portfolio, capital rotating into gold miners, copper, uranium, and energy. So some people are picking up on this, that's for sure. You have Steven Hanke again talking about entering the commodity super cycle. You should be long everything. He's talking about stuff like lithium as well, but that's a little obscure. We don't need to be that obscure. We can just get into the traditional assets and traditional commodities. And they're talking again about the global economy here, missing 1.6 billion barrels of oil, and the economic implications cannot be understated. He talks here, only 70% of lost oil production may be restored after 3 months and 88% after 6 months. If this is true, the global economy could be missing 1.6 billion barrels of oil. So with that said, we'll kind of start to wrap it up and just talk about a few more advantages to trading in futures. There's that tax efficiency. All futures and futures options offer tax efficiency. You can lower your tax rate dramatically. Just because of that, the IRS treats these, they call them 1256 contracts. So they treat these differently than, say, traditional securities and other traditional investments. So you have a situation where 60% of your gains then are taxed at the capital gains rate, and then 40% at your personal rate. So here's
at a long-term capital gains rate is 60%.
Yes.
Yeah.
So I had a short little example here, but we don't want to get too deep into the math, but you had a $100,000 futures account, and let's say you generated 20% profits. Your internal rate of return is 14.64% in our example, versus individual stocks. Had you been trading individual stocks and it had a 20% return, the tax savings is over $2,000 just because you're in a tax efficient space, and you have that favorable advantageous tax treatment. And there's no more itemizing. That's another big advantage. I don't know, kind of get a chuckle out of this picture here. No more itemizing each trade, all the wash sales and everything with securities. You have a 1099 with your profit, one number for the end of the year, and that's all you need to file your taxes when you're trading futures and futures options. But always consult your tax attorney or your advisor for advice on that. We're not giving any tax advice. Then another advantage here too, if you didn't know it, you can trade a self-directed IRA. So we work with Equity Trust, and we had a presentation with them a few months back, but at the time they had 71 billion in assets under custody, and I think it's probably a bit higher by that, but they will work with you. You can have your self-directed IRA with them, and you set up an account with them, tell them you're with Altavest, and they'll waive their setup fee. So I think that's normally $250 or something like that, but nice benefit for you there. But self-directed IRA available through us as well, or you can trade that account with us. And then you have us, we're here to help you. That's really what we do. We've been doing this a long time. So coaching and education. And if you're thinking, I've never done futures, I don't know anything about it. Well, we do have some education available if you want to kind of, jump into the futures basics overview and looking at stock index futures and options and futures options and stock index options and advanced strategies and on, but that's all available to you as well as a client of ours. And here's something here, Mike, do you want to talk about this real quick? Futures contracts to trade S&P 500 equity market sectors. I know you've been looking at these a bit. And these are just some
Yeah.
examples.
Yeah, so the S&P has 11 different, major sectors. Obviously, another way to play the commodities boom right now, especially with energy, it would be something like the S&P 500 E-mini energy sector futures. So today, that is up 0.81%, and I think the margin is about $8,000 on that contract. You're controlling about $122,000 worth of energy stock, company stock value. So I think the biggest weights in that sector obviously are Exxon, Chevron, and then you go on down the line, you get some of the oil service companies, but they're all companies in the S&P 500, probably about 30 companies or so.
Right.
So yeah, I mean, there's, aside from the energy sector, you've also got the tech sector, which happens to be leading today, up 1.31%, and so on. Healthcare, utilities, and so on. So there's all these 11 different sectors in the S&P.
Right, right. So basically, you can have exposure to various securities with these sector futures, is what they call them. So, and you still get that advantage with the tax efficiency and tax advantaged accounts with your self-directed IRA if that's something you want to do as well. So yeah, these are really interesting. These are actually becoming more and more popular. And then this is something we wanted to let you know about as well. This is coming here this summer, according to the CME group. So we think it's a really, really unique, interesting opportunity here. But you can actually, coming this summer, trade futures contracts on your favorite stocks. So you'll see here, these are single stock futures. And essentially you take a stock and you convert it, they've created a futures contract. So you get all the capital efficiency of trading futures. So if you wanted to trade your favorite, Amazon or Amgen or Nvidia, Microsoft, Tesla, Disney, Caterpillar, Intel, JP Morgan, Starbucks, what have you, I think there's 54 US stocks available starting this summer. So that's kind of interesting too. I don't know. I think that has a lot of potential. I think the volume is going to grow rapidly and very quickly in those markets.
Yeah, I think each one of those contracts is basically 100 shares of the stock. So, something like Nvidia, I know it's over $200, or I don't know exactly where it is at the moment, but say it was at 200, that's $20,000. If I'm doing my math right,
Yes.
of stock value that you're controlling. So your margin is likely going to be less than $2,000 to control $20,000 worth of stock.
That's right. So again, you get that capital efficiency, huge benefit in the future space. So with that said, we have a link and a QR code here, and I'll go ahead and put that in the panel. Let's see here. So cf.altavest.com, and we just use the word gold to make it easy. And let's go ahead and send this out so you can see it here. And this will take you to a page where you can just fill in your info, and then we'll contact you and find out what it is you're interested in doing, sort of a free consultation. Tell us what you have in mind, and we'll go ahead and open it up for any questions. I see, let's see here. Here's one question. Oh, go ahead.
Go ahead.
Well, one question we always get, and I'll go ahead and answer it now in advance, is I'm in Canada or I'm in XYZ country, can I have an account with you? And the answer is maybe. It just depends on where you are exactly. And we'd love to have your account with us and do business with you and get to meet you and chat with you. But sometimes, there are various regulations that get in the way of that. So just reach out to us anyway and tell us exactly your specific situation, and we'll let you know if we can work together or not.
I think we addressed this question, but you know, so a lot of people ask, you know, which market should I pick? And you know, at the moment, I would certainly lean towards the Bloomberg Commodity Index. You get a broad-based exposure, and can certainly tailor that to almost any account size.
Right. Well, and that's another question. People want to know what size of account should I trade with, and I think the answer is different for everyone. It really depends on your personal preference and the risk capital you have available and what your goals are. So it really is
Right.
up to you. I would say minimum of 10,000 though, because then I always hear the next question, well, what's the minimum? So I think that's probably a minimum to be able to have some exposure to various markets and not just do only one thing. If you had any more thoughts on that.
No, I think that's about right.
Yeah. And what else is there? Again, IRA, self-directed IRAs, we get those every week. So we do those often. And sometimes people have an IRA they haven't been using or paying attention to, things like that. So talk to us about that. But, you know, we'll let you get going here, folks. We've kept you just over an hour, and hopefully you've found this informational and entertaining all at the same time. But reach out to us, and in fact, let me put that in the message there. I'll just put my email here. It's Eric at Altavest, ERIK. So feel free to reach out and go to that next page, fill out the form, and we'll be in touch, and we'll work together on putting a plan for you in place and see about getting you involved in these markets. Anything else, Mike?
That's it. Thanks for joining us, and have a great day.
Yep, sounds good. All right, everyone. Bye-bye.